All right, welcome back, traders. John Caruso coming to you here for the morning of October 18th. Of course, we're going to run through a couple charts for everybody here today, but first we'll give you some of the headline market risk coming into today. Of course, yesterday we did see the retail sales release for the September outlook. We did see an increase in retail sales, up 0.7% versus up 0.3% month over month. To be honest with you, I think that simply reflects that consumers are paying more for their staples, gasoline, food, things of that nature, and simply buying less with their money. So I think that certainly contributed to the upside move in retail sales. We did see that Iran foreign minister is calling for an oil embargo against Israel in the overnight. We did see a spike in crude oil prices overnight above 88, but we are starting to see that move fail quickly. We'll pull up a chart of oil here shortly. Bank of America earnings yesterday. Now, they did beat on the top and bottom line, both EPS and revenue. However, they did confirm that credit card delinquencies are up 50% on a year-over-year basis. So you've got expanding debt on credit cards for consumers right now. Personal savings rates have fallen recently to nearly all-time lows. So when people suggest that the consumer is in good shape, those are some things that I point to that might not matter immediately, but they will matter. They will certainly matter likely over the intermediate term. So keep all of that in mind. We did see a pump higher in the 10-year yield yesterday, up to 486. That's confirming what we've been mentioning for the past couple of months, and that is that inflation remains sticky and is not going anywhere anytime soon. So that's just a brief recap of some of the headline risks coming in today. Let's jump over to the chart right now. As you can see, we've got a daily chart of the S&P 500 pulled up for you. I'm going to expand the chart a little bit here for you as well so I can show you this tight range that we've been in. It's been about a 65 to 70 point range. We'll call it about 43.50 on the downside, up to 44.20 on the upside. I've got compression in my Bollinger Bands right now, which suggests a breakout is coming out of this range that could be anywhere between 150 to potentially 250 points wide. So once we break out of this range, whether it's 44.30 on the upside or below 43.40 on the downside, you could see expansion of that range by about 150 to 200 points. Now, what you have to be careful of is if we do get a fast move up initially in the S&P 500, and then you see that move fade aggressively back to the downside, you've got to be careful of that first move that we see that looks like a breakout and ultimately fails. That, of course, could happen on the downside as well. If we get a breakdown in here and then a reversal back to the upside. So you've got to be aware of that type of trading action. Clearly, the algos are having a lot of fun with this tape at the moment. I think yesterday we saw the market actually dive to about 43.68 in the morning following the retail sales number. And then we saw it shoot to as high as 44.20 back to the top of the immediate term range by late morning. And then, of course, finished basically unchanged for the session. So be careful chasing moves. Fade the edges in here, and I think you're going to be all right with the S&P. I actually still believe that we are in a period of risk, and that is going to last. As you can see how we have this drawn in here where we'd see some upside chop. That's precisely what we've seen, and then we ultimately get another failure on the downside. Now, because of the magnitude of this run on the upside, I'm not so sure we're going to break back through these old lows down here around 42.30. So if we do get a pull down in here, you might want to wait, watch, cover, take some gains if you are bearish alongside of us here, and just kind of wait and watch to see if you get further confirmation on the downside. So that is my my outlook on the S&P 500. Once again, I remain agnostic. If this market does look like it's about ready to burst on the upside, of course, naturally we will change our view. But until we kind of break out of this immediate term range that we're in, this choppy range consolidation period, and we get out of that period of risk, which is between now and the beginning of November, we are going to maintain a bearish view on this market for now. So that is a look at the S&P 500. I'm going to jump over, take a look at gold quickly, and then we're going to look at oil. Clearly, gold, let's pull it up here, had a big breakdown over here in gold back through 1915, and we saw that plunge as deep as 1820. Now, of course, we had the reversal signal. This was a sign that a reversal was coming of trend, and the inertia behind this move has been so great that it has carried us approximately $150 off of that low. The morning high in December gold was 1975. I've got positive momentum developing in here. We're back to bullish trend, and I actually do have a positive divergence setting up here, where that is telling me that price action is higher, clearly, and I don't have an immediate term overbought signal just yet. So we could see this continue to stretch across the range, perhaps up to this the old peaks up here about 2010 to 2015, before this starts registering an immediate term overbought signal. So we are bullish gold. We do hold bullish gold positions on the books, and we're going to continue to trade that from the bullish side. We are not yet overbought. This could continue to stretch across the range, like we mentioned, back above 2,000, and then at which point we might start seeing some consolidation, some chop before another burst higher coming perhaps out into next year. Clearly, the geopolitical climate is very, very hot right now. I do also take a look at United States deficit spending. We just ran a $2 trillion deficit for the fiscal year that ended at the end of September. Deficit spending is likely going to continue. That's going to continue to add to the United States national debt. We've got rising interest rates. The cost of servicing the debt right now is astronomical, and it's only going to get worse when the debt rolls over after the first of this year. So gold is my insurance play going forward. So remain a longer-term bull on gold. We have been a bull since late 2021, late 2022, and we are going to remain there for the foreseeable future. So that is a look at the gold market. Jumping over to crude oil. Crude oil is actually fading off of that spike high, off the news of Iran calling for an oil embargo on Israel. So that's a failed breakout attempt in oil. Of course, we do get the oil inventories in about 5 minutes, and this has been fading here basically all morning. We're back at about 86.50. Still negative momentum in here. This downside force, this 13% drop we saw a few weeks ago, this is still pushing down on this chart. But ultimately, what I think has happened in crude oil is that we have just basically unlocked a higher trading range in this market. As you can see, for a while, all last year and part of this year, we were trapped inside this, we say about 68 on the downside to about 83 on the upside. We were trapped inside of this range. And now what I think we've done is we've just simply unlocked a higher trading range for this market. So anytime you see it down along 83.50 or so, I think it's going to be a long side trade. You get up here around 94, it's probably going to be where you're going to want to be looking at trimming profits. So, but at the moment, we only want to trade this from the bullish side. We are going to certainly be mindful of risks. Of course, if we break back under this 81.75 level, that could be a warning that something is changing in here. But until then, we think we've unlocked a higher trading range in crude oil, 94 on the upside, 83 on the downside. Trade accordingly. Best of luck to everybody out here. We'll catch you back here next time. Take care.